All right, welcome to the Iron Condors webinar. My name is Harry Swaminathan from OptionTiger.com. I think most of you know a little bit about me, so I'm not going to spend any time on this. Let's get right to the webinar agenda. So, what exactly is the Iron Condor trade? So, what we're going to cover in this webinar, and hopefully, if you, it'll be good if you already have some idea of what an Iron Condor is. Certainly, you'll be required to know what a credit spread is. So, we're talking about the bull put spread and the bear call spread. These are the two credit spreads, and those that's what makes the Iron Condor. So, hopefully, you've got some background on that, and then we'll discuss what kind of stocks are a good candidate for an Iron Condor. So you have very volatile stocks, and actually, the one that I'm going to show you is has been volatile in the last few months. So we're going to take a volatile stock, and on the other side of the spectrum, you could choose something that's very stable. So, a candidate like IBM would be a good example of a stock that's very stable. It doesn't have too much volatility. It's got a band of, a range of prices it trades in, and it stays within that for the most part. There's no huge up moves, there's no huge down moves, uh, unless, of course, like I think the last earnings report on IBM was a little bad, so it got hammered about $10-15. But that's very rare, and IBM is very, very stable, and it's got a very low standard deviation. So that's what defines the volatility of a stock. So then we look at what are some good trade entry considerations. Well, what are the trade entry considerations? Whether it's good or bad, I think a lot of it will depend on your individual situation. But we'll take a discussion along those lines. And then our trade candidate for today. I'm sorry, I need to expand this into a full screen. Our trade candidate for today is going to be Tesla. So we'll study the Tesla. We'll put an Iron Condor on Tesla and take a look at that trade. And then what we're going to do is analyze the Iron Condor. What's good about the Iron Condor? There are several things that are excellent about the Iron Condor. In fact, I think if you look at all option strategies, the Iron Condor probably has some of the most favorable characteristics. So we'll look at what those are. We look at what are the bad things about an Iron Condor, and finally, every options strategy has the good, bad, and the ugly. So we can't ignore the ugly. In fact, I would say that the ugly of any option strategy is probably the most important consideration that we have to give. So, and then of course, just like any other options position, adjustments are key to the Iron Condor. We'll discuss some of the more popular adjustments or some of the more common adjustments. And then what we'll do is we'll open it up for Q&A, because what I really want is if you guys have questions, then let's take a look at those questions, and I'll be happy to answer them. So that's as far as what we have, and that's about it. It's a one slide presentation. So what I'm going to do now is go back to our Think or Swim platform and take a look at what we have here. So this is a stock of Tesla Motors. It's been a very volatile stock. So what do we mean by volatile? Let's take a look at it. This is the chart of Tesla. So you can see, all through the beginning months of this year, from January, Feb, March, and even up to the end of April and beginning of May, you can see that there is no, really, this is, you would almost call this a boring stock. Doesn't make much moves except for one day here or a day there. It really didn't make anything. But look at what has happened to Tesla after May. This is just unbelievable, unbelievable. And look at the range of these bars. So this is a very volatile stock right now. Tesla is a stock that is in play. So it's got huge moves, and if you take a look at its volatility, and the way you look at volatility is you always come down to the option series, and on the right hand side you'll see the volatility. And of course, these are represented in percentages. But the important thing to understand about these numbers is the number only pertains to that particular series. So the July series has a volatility of 58%, and that 58% is calculated based on the number of days that are left. So you can see Thinkorswim also puts a plus or minus number. So that is the amount it's expected to move in those 21 days. So you can see this is like about $25 in 21 days. It's expected to have a range of $25, and that represents one standard deviation. So that's only 68% of the time on a statistical basis. It could be actually be much more. All right, so that's as far as so it is a volatile stock. So I mean, that was the point I was trying to make. Now what we have is trade considerations. So, should you go for a volatile stock, or should you go for a much, more, what do you call, a stable stock like IBM? So, if you look at IBM's chart, for example, what you'll see is that, of course, IBM has seen, yeah, this was the one big move that IBM has seen. And actually, IBM has been, it's been moving quite a bit on a daily basis, but IBM is a $200 stock. So you would expect its daily range to be somewhat higher than a $100 stock. But the important thing is, again, if you go look at IBM's volatility, look at that. That's 20%. So you can see that IBM is almost one third of Tesla when it comes to volatility. So that's what I mean by a stable, stock. So the same series, July series, you can see IBM is expected to move plus or minus 10, whereas I think Tesla was a lot more. In fact, this is a little high, the 28%. So if you look at some of the other percentages, it's not a whole lot. Regardless, so that's the implied volatility. Now there's pluses and minuses with a volatile stock. So let's go back to our PowerPoint presentation. And what I mean is, if you if you if you look at the trade entry considerations, so I think there are three main things that you have to consider when you look at an iron condor. The first is, okay, what is the volatility of your options in relation to its historical volatility? So, if a stock generally has about 28-30% volatility, what is the current volatility as compared to that historical volatility? Because the higher the volatility, you're going to get more premium, because that pumps in air into the options, and you're going to get a higher premium for those options. But with higher premium, higher volatility, you're also going to face a higher movement. So when we take a look at the iron condor risk graph, you'll understand that movement is not a good friend of the iron condor. All right, so that's as far as volatility. The expiry series, I think, many people like to do it on weeklies. Weeklies move really fast. And if you're going to do an iron condor on the weekly, then you must be very nimble, which means that during market hours, you have to be following your position. Even if you take a lunch break and come back, the position could look vastly different than when you left. So the weeklies are a very high energy kind of a trading environment. It's not suitable for a lot of people, especially people with jobs, and if you have other things to do during market hours. Then you have the monthly series with, let's say, about 30 days left to expiry. And then you have further expiry series as well, which may have 60 days and 90 days. I think the ideal scenario for an iron condor, if you ask me, I would say it's about 45 to 50 days. You can put the trade on when you have about 45 to 50 days. You're going to get a good, decent premium. You're going to be able to put probability on your side and go out of the money, and make the trade's risk reward profile favorable or somewhat acceptable to you. And risk reward probability, all of these are all tied in together. The premium that you receive, the risk that you're taking, the how far out of the money you're going to go to put your short strikes. All of these are connected. All, implied volatility, standard deviation, they are all connected. So you can't separate any one of them from each other. The option prices take into consideration all of these factors. So, let's go take a look at Tesla, and let me show you what we got here. Right. Okay, so here you can see that if you go to the what I have here is four spreads. I've got two spreads in the let's see, why do I have 80, 75? Okay, no, I didn't mean to do this. Let me go back here and change this to July. All right, so this is an iron condor in July, which has about 21 days to expiry. You can see here. Let's go take a quick look at what this is. The July series has 21 days and the August series has 49 days. So when we look at the risk profile, the iron condor is comprised of two spreads. One is the bull put right here on the left hand side, and on the right hand side, you'll see a bear call. Now, so in general, you would want to put the iron condor, if where the stock price is right in the middle. So here you can see it's equidistant, or somewhat equidistant from both of these. The stock is currently trading at around $109, and we have plus or minus 10% lines right here. So you would go to the July series, you'll get much less premium, obviously, and your risk, your reward is going to be less. But what is your risk? You're going so far out of the money, and so you can see the 10% lines are here. So you're way past even the 20% lines. But that's the kind of movement that Tesla might make. So that's what you have to be careful of. Whenever you have stocks that have a very high volatility, you're going to see that you'll be able to go a lot out of the money. However, the movement, at least the historical movement of that stock, has shown that that the stock can move. So anyway, so if we look at the risk and the reward is only 400 on a risk of 4,600. So you can see that the risk and reward is very low. So you're getting a 10% reward for a 90% risk. However, what you're also getting is a 90% probability of success on this trade. So that's as for, if you go to the July series. Now, if you see the August series and look at the strike prices, we can see that we can go even further out and still get decent credit. So, here we have an 85 by 80, here we have an 80 by 75. So we've even actually gone further out, but we are going to get more premium. Therefore, our reward is going to be more. However, now there is a lot more days. So the stock has that many more days to make a move in either direction. So that's what we have to watch out for. So let's take a look at what the August series looks like. The August series looks like this. I mean, it looks on paper, it looks great. It's got a reward of about, the max profit is 1,050, and the margin or the max loss, max risk is 3,950. So here you can see your reward is 20% and your risk is 80%. However, what you also have is a probability of approximately 80% of success. So basically, as long as Tesla does not hit these short strike points, so this is at 80 and this is at 145. Now you can see that there's a lot more room on the upside. So maybe we can even come one strike price closer to 140, 145. This will give us a little bit more credit. So now we have a max profit of $1,200 and max risk is $3,800. All right, so these are all the good things. You're getting double the credit, your margin is less than a regular credit spread, and you're truly non-directional. You don't care which way the stock moves, and you can see by your delta, you have a delta of -3, which is as close to delta neutral as you can get. So this is great, and these are all the excellent features or the plus points of the iron condor. Now, what are some of the negatives? What are some of the negatives? And we'll talk about the bad first, and we're not getting to the ugly yet. We're only going to talk about the bad so far. The bad, I would say, in the iron condor is one of the bads is that it is a negative gamma position. It's actually, that is part of the ugly. So I don't want to go there. One of the bads is that it's also a negative vega position. So what you're going to see is if implied volatility increases, then your position is going to suffer because you have a negative vega. um, and one of the other bads is that the iron condor does not like big movements. So, if you make a huge move, you can see that your white line is going to show you, quite a bit of loss. So it doesn't like huge moves. Therefore, your mindset when you put in an iron condor is to see how you can keep the iron condor in this zone right here. Now, that's a pretty wide zone. This is a very good iron condor. You can put it in the August series. It's got 49 days left to expiry, but you don't have to hold it for 49 days. Even if you hold it for 30, 35 days, you'll see that quite a bit of time decay is going to come out of these options. And perhaps, in fact, let's say the stock stayed the same, and let's just move the dates by 1 month. So here we are on June 28th. So what I'm going to do is move this to, let's say, July 31st. So about 33 days. You can see that quite a bit of time decay has come in. Obviously the stock is not going to stay in one point, but this is just to show you the concept of how much time decay can accumulate within 33 days. You can see that your profit is going to be about $915. So time decay is working in your favor, which is good, which is great. In fact, you have double time decay because you have time decay from the bull put as well as the time decay from the bear call. So that is definitely great because you have double time decay. But even if you hold it for 30, 33 days, you can see that you can pick up a decent profit. And at the end of 33 days, look at your profit zone. That is these little red vertical lines over here and over here. So your profit zone starts to increase as the days go by. So if I reset the parameters, you'll see there is no profit zone. But as you increase the date, you'll see that a profit zone starts getting established, and that's really what you're looking at. So if we go up till June 7th, which is about 9 days, I mean July 7th, which is about 9 days away, you can see that you've developed a profit zone. So which means between this point and this point, your iron condor is somewhat safe. And so those are all the good points. Now, but it doesn't, in general, it doesn't like movement. If Tesla makes a $10-20 move in one direction, your iron condor is not only going to show you a loss, which is not a huge deal. You can always adjust it. However, your the parameters of your trade, so the delta, the gamma, is going to change significantly, and that's really where the where the real bad stuff about the iron condor starts coming in. Because it's very possible that these volatile stocks make a move of 20, 30, $40 over a period of 5 days. It's very possible. And when a stock like that does that, then what you're going to see is the white line. I mean, you can argue all you want and say, hey, as long as it doesn't touch 80 or as long as it doesn't touch 140, I'm fine. However, what you really need to look at is how much losses is your position showing you, because that's critical. And we have only what do you call I mean, right now we have a lot of days, but as the days goes by, time decay will be in your favor. But if a sudden move happens after some time, let's say after about 2 or 3 weeks, you go into this trade, you'll find that this white line is going to become very, very steep, and that's because of the gamma factor. um, you know, I just want to point out that gamma is the cause of the slope of your white line, because as you approach one of these options, you have a negative gamma on that option. And so that negative gamma is actually pushing the deltas even faster and faster because, this option is approaching at the money. So gamma is the cause of all the problems. So let's say, if we were to move this option about 2 weeks in time or 3 weeks in time, I'm going to go into July and put it at July 15th. From time decay, you can see that, you would make a profit. However, let's say the stock made a huge move. So from 108, let's say it went to 85. Now you'll see the graph. It's completely changed, and that's because of gamma. So, gamma will start working against you, and it'll actually speed up the process of working against you. And so, that's the problem with the iron condor. When as time goes by, you're benefiting from theta, but you don't want movement. And as you approach expiry, you, you don't want movement more and more. So, a movement in the end can hurt you quite a lot. A large move in the end can hurt you quite a lot. And of course, you're going to show some paper losses, depending on where the stock is, and all of that. So that's the ugly part. Obviously, adjustments. It's better to be a little proactive rather than wait for it to come to any kind of dangerous position and then try to adjust. It's obviously much better to take a proactive approach. Give yourself some points. Put some mental markers, like let's say it's at 108. Let's say at 125 you want to adjust. At 125 you're probably looking at a loss of about $400, and you may want to adjust the iron condor. The common type of adjustments for an iron condor is one of the things that most people do, which I'm not very fond of that, but this happens to be a very popular adjustment. Is when let's say it moved here, you would take this bear call off from this month and move it over to the next month. And by doing that, you can go further out in the next month, let's say at 150 or 155, and still collect enough premium in that next month to compensate for the loss that you took on this position, and then you still get premium. I'm not saying it's a bad adjustment, and I think if someone doesn't have time to deal with adjustments and everything, it's perfectly fine. um, my only problem with that is, very often I've tried it, and whenever I've tried it, you're always constantly you tend to get into a rolling situation. You roll it from one to the other, and so it takes a long time to realize your profits sometimes. So that's my only thing. Otherwise, there are some of the other adjustments that you can do to an iron condor. You can reduce the number of shorts you have. Let's say the stock is approaching your bear call, then obviously the bear call is in danger, but your bull put is going to be doing well. So you could bring the bull put in some more, and you can pick up a little bit more credit. You can move the bear call. You don't have to roll it to the next month. You can just roll it higher to a higher strike price in the same series itself. No, that's not a bad adjustment. If you can move this one here and this one a little bit closer, you could potentially come out with an even trade right there. So that's possible. But then again, when you do things like that, what ends up happening is the stock goes up, then the stock comes down. So in general, you want to try to avoid this over adjustment business. So that's why I think it's always, if you don't have, I mean, at the end of the day, it comes down to this one factor. Everything in options trading comes down to this one factor: how much time do you have to devote to the markets? That is a prime question that you have to ask yourself, regardless of what kind of trade you put in, because that really determines how you should place your trade in terms of a risk and reward profile. If you don't have time to look at the markets, I would say, why 140? Go all the way, up to 150, and over here come down to 70. Give yourself a 90-95%. You'll make only 5% on the trade, but why not? I mean, that's a perfectly valid return. You're giving yourself a 95%, 90 or 95% probability that the trade is going to expire worthless, that the iron condo is going to expire worthless. So, I would move it to, let's say, I'm just going to try this 70 and let's say 65 and see what that looks like. And over here, let's go to say 140. Oh, we're already at 140. I'm sorry. 140. No, we're not. We're looking at the other trade. Okay, hold on. 140. You want to sell the 70 and buy the 65. Okay, that doesn't give you any. It gives you only 5 cents. See, so okay, so that's too less. So let's go 75 and 70, and even that doesn't give you anything. So frankly, yeah, you've hit the max points on that, so which tells you that there are two less days to expiry, so you really don't have any room on your iron condo. There's not much premium left, so which means it tells you automatically that you need to move over to the next month. But let's try the next month and say, let's go for the short, I'm going to go at 70, and for the long, I'll go at 65. And then instead of 140, we can go to say 150 and 155. So if we did that, we're picking up only a $500 credit. So we're picking about 55 cents, $500 credit. Our risk is 4,500. So basically, it's a 1:9 kind of a reward and risk profile. But whenever you have, that kind of a profile, what you must understand is that you have an inverse probability of success. So the probability of Tesla hitting all the way down to 70 or all the way up to 150 is basically about 5 to 10%. It's 5% this way and 5% this way, but the stock cannot be in both places at the same time. So it can only be at one place. And therefore, you really have a 95% probability of success. And you're going to pick up $500 on a margin of 4,500. Hey, that's not bad. That's 10% of the trade. But obviously, you're not going to be able to do this in a consistent basis because stocks move, volatility is going to increase. You're almost always going to face some kind of a problem and then you have to adjust the trade. And therefore, that's really the key. How do you adjust the trade? And how do you manage the trade, which of course comes down to how much time do you have. Do you have a lot of hours during the market hours? Then you can come a little closer. If you don't have a lot of hours, I would put something like this. And of course, this takes 49 days. So even in 30 days, if you get half of this, that's $250, which is about 5% return. That's not too bad. So depending on your situation, what you can do is, pick the trade appropriately. Um, Put some mental markers as to where you want to adjust it. Always, I think, try to avoid over adjusting, and set up the trade and have some realistic expectations as to what you can get out of the trade. The iron condor is beautiful. It's a non-directional trade. Your stock can go in either direction, and you can make a good trade out of it. So that's really what I had to tell you about the Iron Condor. And I would welcome any questions that you have, anything that you are a little unclear about on the Iron Condor. I'll be happy to, you know, explain that. Please use the chat box. The question box is not, I have to reply to the question box for it to even show up. So if you have any questions, I would suggest let's just try to use the chat box right here, and you can ask me any questions on the iron condor. Markets went down actually today, and they are now trying to come back. It's about a couple of points down, which is not too bad. I think some kind of a news might have come out in terms of either the consumer confidence or something at 10 o'clock, because it went down to about 8 or 9 points, 10 points at that time. So anyway, what else is going on? So some of the stocks that are in play, gold is just getting hammered big time. Gold is just getting hammered. Oh, it's finally made a little positive move here. Otherwise, gold has been coming from. Let's look at the gold futures for the last. I would say for the last, yeah, 4 to 5 months. It's come down from 1700 all the way to 1200. Today it dipped to 1179. Unbelievable. And of course, last year sometime I think it made the all-time high at 1900. So gold has been really getting hammered here. All right, folks, any questions? Please use the chat box. Otherwise, we can wrap this up, and hopefully, you guys have enjoyed it. And I'll be recording the webinar for people who missed it, and even you'll get a copy of the recording. But let me know if you have any questions. Last call. Okay, all right. Thanks a lot, folks. Have a great Friday. Have a great weekend. I look forward to catching up with you soon on a different webinar, different topic. But we're going to try to make this somewhat of a regular feature. So I look forward to seeing you guys there. Thanks a lot. Bye bye.